everyone, this is Purti, and in this video let's talk about options. In my previous videos I talked in brief about calls and puts. Today let's get into its details. So what are options? Options are contracts that give the bearer the right but not the obligation to either buy or sell an amount of some underlying asset at a predetermined price at or before the contract expires. Okay, that was extremely technical. Let's just break it down today and let's just look at the right to buy. Let's take a real life example to understand this better. Let's say we have a house on the market with a price of $250K. A broker is selling contracts for a price of 10K to buy the house at 250K in the next 2 years. If the house is hot and the market is hot and you think that the house value is going to go up in the next 2 years, you might purchase the contract for 10K so that you have an option of buying the house at 250K if the house value goes up. Let's say in 2 years the house price goes up and is currently at 350K. So you can exercise your contract because it gives you the right to buy the house at 250K. So you purchase your house at a lower price than the market value with a profit of 100K. This contract is only valid for 2 years, after which the contract expires worthless and you will lose the 10K you paid for in the contract. But if the house value goes down to say 200K from the original 250K in 2 years, you will encounter a loss of 50K if you exercise the contract. But you will not need to exercise the contract because you would rather just buy the house at the market value and your total loss would be just 10K for the contract you just bought instead of 50 plus 10K, that is 60K. So if you see, a contract worth 10K allows you to control 250K worth of value, and that is leverage. Your risk is limited to 10K and your profit is infinite because the house can technically increase in value infinitely, although the time in the contract is limited. Let's take another example. Let's say you want to buy a pizza which costs you $25 from the Happy Pizza place. Someone is selling some coupons for $5 each, which lets you buy a pizza at $15. If you choose to use the coupon within the next 6 months. If you don't use the coupon in the next 6 months, you will lose the $5, which was your risk. If you use the coupon, you get to eat your pizza at a discounted price of $15. So your total savings is $25, which is the original cost of the pizza, minus the $15, which is the discounted price of the pizza, minus $5, which is the coupon price. So your total savings is $5. This whole trade in financial terms is called a call option. Just replace pizza or a house with a stock and the contracts and coupons with options. Option price with the price of the coupon or the house contract and the predetermined price of the house or the pizza in the contract and coupon as the option strike price. Now that we have understood all the terminologies, there is something known as an option multiplier. Just assume that instead of just one house per contract, a contract controls 100 houses, or one coupon can buy you 100 pizzas. So 100 is known as a multiplier in the options market, where each contract gives you a control on 100 stocks, and if you plan to exercise the contract, you will need to put up money worth of 100 stocks when you buy them at the strike price. So the option premium is the price of the option times 100. The premium or the cost of the call options increase as the stock increases in value. The call option gives the buyer the right to buy 100 shares of stock at the call's strike price. Let's take an example of Tesla, which is the most sought after stock right now. What you see in the screenshot is called options chain with expiry dates ranging from 5th March 2021 to 17th March 2023. The stock is currently trading at $621.44. Let's buy a call option with a strike price of $625 with 1 month expiry of 16th April. The column on the left in black is called the call options and the put options are on the right in purple. To buy a call option, you right click, say buy and click single, which is the name for call options. If you notice below, the price of one call option is $62.20. Remember what I mentioned to you about the option multiplier? So the total premium that you would have to buy this call option for is $6,220. If you find it confusing to multiply this every time, you can go to the Analyze tab on the top to view the graph of the call option you're planning to purchase. If you see, the blue graph indicates the price of the stock at expiry of the option contract. Your total risk is limited to $6,220, which is the option premium. And your gain is actually infinite, limited by the expiry of April 16, 2020. The purple graph indicates the profit or loss as of today. As the time progresses, your call option price also increases if the stock goes up above $625 strike price. If your stock falls, you can lose up to $6,220. So since the reward is infinite, technically your reward to risk ratio is also infinite for an initial investment of $6,220. Sounds fantastic, isn't it? And almost too good to be true. In fact, it is true, and this is what leverage is and why options are a better choice to invest in if you do not have a lot of capital to begin with. You can make money quickly and then think of investing in stocks for a long term with the capital gained from the options. So that wraps up this video on the basics of call options. In the next video, let's look at how option prices increase in value with the stock price increase, the details of the graph of the call options, and why exactly the Tesla call options are so expensive. Let me know what you think of this video and post your questions and comments below. And keep in mind that this video is for information purposes only and should not be interpreted as any financial advice. If you like this video, don't forget to like, share and subscribe and hit the bell icon for more videos of financial literacy. Thanks for joining me today, and I'll see you all in my next video.